6 women in management, in appraisal management companies across the entire United States, and we all knew each other and talked to each other all the time, and we were all at a different company. Um, Still keep in contact with 3 of them to this day. So yeah, super fun.
That world has changed over time, though. It's
It,
how an
it
appraisal
has.
was conducted back then and how one is ordered now.
Yeah, very different thing for sure. Well, I was at the spot where we converted from hard paper send out overnight packages to requiring appraisers to have cameras that you could upload photos, and it was like a $2,000 investment for them to get up and running. It was like a hard sell, let me tell you. But
Yeah.
yeah, back in the day. Thanks everyone for joining us. It's Friday. It's not a Tuesday, so it's Friday, and this is The Fix. Unfortunately, Melissa's out of the office today, kind of unexpectedly. So you got me. But with me, you have like 2 of the greatest people that have been in our network for a long period of time. So joining us today is Dave Roberts, who is the mortgage division president at Alpine Bank, and Scott Alexander, who we were just laughing about as the chief risk officer, but he's wanting a different title today at Assurance Financial. So thanks guys for joining me here. Chief risk officer isn't the most popular person in the office,
No,
Scott.
it's like I said, when I walk in an office, it's like turning on the lights and the cockroaches run. Nobody wants to talk to you.
Who are you calling a cockroach?
That's good. Fiorellos would probably take exception to that. It's all good though. Femi has to say I do.
I was
That may
gonna
be for
say,
different reasons though.
same situation, not the same title.
Not the same reasons.
Very funny, Femi. You can always make all of us laugh. So The Fix changed its structure a little bit. I'm sure many of you have been on and already are aware of that. In that we're answering questions from within our network. Pulled out, if Melissa was here, she would have this great big whopping fishbowl that she takes great pride in owning. I do not own a fishbowl, so I am constantly looking for something different. It was a cauldron for Halloween the last time I did this. And the closest I could find, which I'm going to have a team that's going to argue that this is Christmas and not Halloween, because they're in a big debate right now on which you should have decorated in your house. But a great big gingerbread bowl that I will be pulling questions out of for Scott and Dave to hopefully answer. So I think we will get going. Ashley has already said it's Christmas. There's this big old debate on the team on
Faith, more important, before you ask us a question, the most important question, does homemade gingerbread get put in the gingerbread bowl?
it does. It does. I happen to be somebody who loves to spend time in the kitchen.
Nice.
And I love to bake more than I love to cook meals, but I do both.
Making is fun. I do a mean banana bread.
I do too. As a
Love
matter of fact,
banana.
that's happening this weekend at my house. I've already promised to the kid that he will have banana bread tomorrow morning. So
If you don't already do it, add chocolate chips and pecans or pecans, as we say down here in Louisiana, to the bread. Takes it to the next level.
well, now I do the chocolate chips, but I have a nut allergy, so the tree nuts
Ah,
would kill
okay.
me. So
You don't want to do that.
we won't do the pecans, but might have to add some chocolate chips in there this time. All right. Well, I've got the first question out of the bowl. I have not read these, so here you go. Are you seeing any scalable technology solutions that are delivering results for clients and portfolio retention and showing an actual ROI? Who wants to jump into that one?
I'll jump in, and I won't give a good answer, but technology has been one of my pet peeves, and so the short answer to the question is no. We don't service, so but retention is important, obviously, to our past clients and kind of the reason that we exist. I've been talking to our vendors and we don't have a real big tech stack, but you know, my experience has been that they sell you on the concept, they sell you on, you know, the pickups you're going to get both on the production side and the support side. They come in and get it installed, and then you don't hear from them until the next renewal period. And for a shop like ours, we're 15 LOs in one state. So we're pretty small, and we don't have tech resources internally to commit to the project. So it's a real challenge for us to A, get adoption, and B, keep up with the changes and things that we need to tweak it to make it more profitable or you know easier to use on our side. I've yet to figure out a way to calculate an ROI. It's so nebulous because you know, the pickups are supposed to be in minutes and hours versus you know, dollars and cents. You have to convert obviously your labor time to dollars and cents and go down that route, but I've yet to be able to find something that made sense to me.
How about you,
So,
Scott?
yeah, so the question, I'll answer kind of the question two ways. First, AI in general, but I think you were asking more as retention of your loan customer, correct?
Yes.
Is that how it's phrased, or just AI in
Well,
general?
it says delivery results for client and portfolio retention.
Okay, so we're kind of like Dave too. You're scared of the AI piece because you're like, okay, how do you really quantify that into a dollar number? So I can speak success, failure, and then kind of what we're doing ongoing. So about 4 or 5 years ago, we were introduced to a company through Richie May, who was a RAL, and they created a bot for us that does our purchase advice. So we had 4 individuals doing that. We got the bot does it by itself. It reconciles the PA, it pays the warehouse line, it puts the PA in the e-folder, and does everything for us. And it does that with all the lenders that we sell to. So we've seen an ROI on that. We've been able to repurpose all 4 of those people into different roles. So that was a positive. We went down the underwriting bot side, and that was a big fail because we could not figure out the red flags and all the nuances of underwriting, and it's still an ongoing challenge. Where it comes in, and at least as IMBs, where we need to look at it, and the bulk of us on this call probably use Encompass. And at some point, they're slowly making the change to the cloud, and at some point, it's going to become part of our LOS, a lot of this automation. And you're going to have the buy-in there. So now it's a matter of, like Dave said, do you spend that money now when your LOS a year from now may have that solution? It's in your cost per loan that you're paying for your LOS already. So it becomes a tough conversation to have because they're not there yet, but you're hoping they'll get there. And they're slowly, I think, eventually going to get there. So it's, do you spend all that money now? Now, as far as portfolio retention, we do service. So we've got about a $3 billion servicing deck that we've accumulated over time. And we've got one of our, I think it may be our total expert, it scrubs that. It gives our LOs alerts. So we get alert if a house gets listed, we get alert if there's a credit inquiry, we get alert if that mortgage customer, based on the rate they're at, if they're low or if the current rates get within a point lower than where they're at now. So it gives our LOs a way to call that customer. And we are seeing positive wins on that, where we'll get a credit alert, they're out doing for something. And unfortunately, LOs are not always calling their deck for that future loan, or they like to make you believe they are. They're not always doing that. And when they make the phone call, they're generally usually able to strike up that conversation and get that loan back. So we have had wins in that area. The interesting part on that, though, is that's all thought about by trigger leads, and everybody's against trigger leads, but a lot of what we do there comes from that. So it'll be interesting to see how that goes on with legislation that's pending and everything. Is, do we lose the ability to have those leads? Because we have seen success for them. Now, interesting, I don't know how many folks on here are seeing the same things, but the refis that are there now, we are having a really hard time competing on the loans that we've sold off to the big aggregators, the PennyMacs, the Freedoms. They are basically cutting it to the bone as far as the rate they're offering to the customers and making it very hard for us to get that customer back that we've sold to them. So they paid a good SRP on the front end for it, but they're making sure they're keeping that refinance and not letting us give it back. So be interesting to see how that plays out as refinance become more and more popular, as we do believe rates will go down.
Yeah, it's interesting. We're hearing that from a number of different people in network about those that you are selling to, trying to capture it even within a couple of weeks after the closing with a rate that would not be attainable for them, thus creating, an early payoff, which brings up a whole different,
Yeah, that's a whole other that's a whole
conversation,
other
right?
conversation.
Yeah.
I've heard of several people that have gotten early payoff, wanting to pull money back, and it's like, wait a second, I sold you a loan and you're paying me off.
Yeah, exactly. You need to make sure that at least that happens. Okay, we're gonna dive into this gingerbread bowl yet again and see what we come out with. Looks like a short. Well, that one, it was not a question. It was the top of a question. All right. Nerd Wallet is getting into mortgage. Well, I don't think that local retail LOs will ever be replaced. Are there things you think lenders should be doing to be more competitive with these internet-based heavy technology companies? And is Amazon next? I think Amazon tried it, didn't they?
They did. And I don't know if you call it a success or not. I think you're going to see everybody at least try to dabble in it. But it still goes back to, I think that realtor LO relationship, especially in the market we're in right now, that'll never go away. You'll be able to automate, or at least as a lender, you need to automate as much operationally as you can to become efficient to compete with them. But I don't know that the L is always going to be needed, especially if you're a purchase shop. I don't see where the big online lender gobbles up all that business. That's at least my opinion on it.
What about you, Dave?
Well, I agree, with Scott, and then, when you're talking about investing in businesses, and banks are prime examples of this. They'll go out and buy a little IMB because they saw a spreadsheet and they made it sing, but you can't get around mortgage being a cyclical business.
Mhm.
And the cycles, when they're down hard, and it's painful. And we all read, I think, the results of Rocket's last quarter taking a significant hit, primarily or almost fully because of MSR markdowns. So they have to assume that they're going to dominate the business, and it's going to keep going up on a steady incline. And this is not the business for that, especially if you're, there's a lot of other businesses to throw money at, in my opinion, but I think that's going to be, and then the other thing that I continue to think about is, with the CFPB, and everybody's really hot on these credit report fees and how they're out of control going up. But at the end of the day, you're talking about $100 or $150 fee, versus title insurance in the thousands, and and comp, not against comp, but does somebody that produces a vanilla $300,000 loan, should they get paid $3,500 for doing that? And how much of that, which is the biggest expense on the loan, yet the regulators and CFPB have never really focused on that. They've focused on structures and net branches and that kind of stuff. So it seems like the regulators focus on things that have the least,
Impact.
Effect on the borrowers as far as financially.
I
Think
agree
about
with
that all the time. I don't know if either of you think about that when you go through a mortgage transaction yourself. It's like, man, I'm like a piece of cake person. I maybe talk to my person once or twice. They're getting paid a lot of money, and I'm the person that's done a lot of the work in figuring this out. But I'm sure everybody in mortgage kind of feels that way about their own own transactions, but after you've done a person once or twice and maybe you're on round 3 with them, they're a known entity to you typically, and those transactions definitely are much easier. I just don't know if we're seeing a lot of those types of transactions in the marketplace right now. It seems like it's a much harder qualifying transaction a lot of the time.
Yeah, there is no easy loan right now. Every loan seems to be different. Even what used to be easy is not easy anymore.
Yeah, exactly. Exactly. All right, let's see what this one says. If you could only invest in one thing for your company in the coming year, what would it be?
You know, that's written in such a way as, you know, if you had to spend $100,000 and you couldn't use it for groceries and rent, what would you buy? You know, I would have to go back to some kind of tech expertise that would be committed to the mortgage process. You know, as I said earlier, we're kind of in between where we don't have a committed tech resource, and that really prohibits us from looking at the landscape and prioritizing what could give us positive results, being able to analyze that outside of the sales pitch that we're getting. So that's probably what I would look at.
Yeah. Femi added in there, I think he thought the question the same as you because he added in there, we wouldn't be in mortgage if we were only doing one thing at a time.
Yeah.
How about you, Scott? What would that one thing be for assurance?
We would invest in a top-notch recruiter with a proven track record to generate top-line revenue and get us some more ultimately volume is what we're looking for. And I think as a company, we're positioned really well. We just need to grow, and it's going to take us growing outside of our established footprint to do that. And that's really what we need. And we've done that. We actually had a big hire last month out of Dallas that hopefully will, we've got 3 LOs starting on Monday in different parts of the country. So we're excited about him. So hopefully, fingers crossed, it's the right hire.
Yeah. Yeah. Great answer. All right. Let's find out what else is in here. Oh, okay. Fairway, Townstone, Citadel, all Citadel Federal Credit Union, all have been targeted by the CFPB recently for some form of redlining. What are you doing to address this concern with your teams?
I'll go first.
There you go. That chief risk officer hat is coming off now, right?
If you're not doing fair lending and redlining analysis, you need to start doing that. I'd recommend that right away, at least biannually or something like that to see where you're at. The other piece is once you get that data back, use that data. Don't just put it in a drawer and say, hey, we did it, it's there. Take that data, take a look at it, advertise in areas where you may not normally advertise at. Put yourself out there. If you have the ability, create a special purpose credit or a special SPCP, special purpose credit program.
Yep.
If you've got I always get that messed up, so I had to say it. But if you have the ability to do that, do that. They're a necessary evil, but they can help you as it relates to that. That piece is not going away. It'll be here no matter who's in the White House. I think that's important that you do those things, and I think if you can show your record of that, you at least are able to defend where you're lending at, as opposed to not being able to do that. So I think that's important. Is you almost got to build a case to defend yourself, even though you probably are not doing anything with intent. It just happens.
Mm-hmm.
Yeah, same from our standpoint. It's really on our radar now, and because we have expanded over the last 5 or 6 years into metropolitan areas in the primary market we had served before. There really weren't any LMI designated tracks or majority tracks, so we were able to kind of fly under the radar. But now that we're in metropolitan areas with designated tracks, we're going to be in the in the eye of the examiner. So, I mean, we kind of follow what the judgment came out on these cases that are coming out, and just you hit all of the topics. You've got products, you've got marketing, you've got branch locations, you've got dedicated personnel, all of that, and it's all, if you read these different findings, they all tend to say the same thing, and the ones I've read have similar dollar amounts of penalties, which are staggering. We started by forming a CRA committee that meets quarterly, so that we have a record of an entity that meets and what we talk about and that type of thing. We set goals by region. We're trying not to have to put together a portfolio product. We're trying to enhance secondary market products. Instead, right now we have a $7,500 lender credit that we're paying for an LMI loan, you know, that's on a secondary market product. So home ready, home possible, that kind of thing. And then, you know, we're just really trying to record what we're running into as far as competition goes and that type of thing. Because, you know, it seems like, and I said earlier, we're not a servicer for Fannie or Freddie. So, you know, if we take on a portfolio product and, you know, heaven knows what could possibly go wrong with a 3% down, no MI, 600 credit score, you know, I mean, then you get in a situation where you're collecting and, heaven forbid, foreclosing in the community you serve for the people that, you know, you're mandated to, you know, put your efforts out there for. So we'll see what happens. And but what we're really thinking is, and we did open up a branch in an LMI tract and have hired some individuals to go and specifically work in minority and LMI communities. So we're trying to hit all the points and then just keep track of how we're doing, and we'll see what happens.
I think, Dave, the biggest problem with that too, and there's a finite number of those borrowers that are there, and you have more and more people out there competing. Like you said, if you don't have 100%, I mean, I've seen 100% no MI at a smoking hot rate that you can't even touch. And it's, yeah, I want to make them a loan, but I can't compete with the local bank that's doing it because they need the loan too.
Exactly.
Yeah. I think it's a great point too. I hadn't really ever thought about it that way. I always read the articles about, and you know, like what each person was fined for, but they're kind of giving you a little bit of a roadmap there. At least I think that was a really great point, Dave. If you pay attention to what people are being cited for and make sure that your process addresses those things and you're watching it closely, I mean, that's probably a pretty good place to start, right?
Yeah, it kind of gives you have to at least focus on it once a quarter in our meeting to say, okay, let's go through these points and what have we done and what do we want to do by our next meeting. So, yeah.
Absolutely. All right, let's see what else we've got in here for you today. Let's pull this one out. Is anyone considering hiring someone that is strong in social media and training them as an LO? So kind of the opposite, I guess, of, you know, what you see. You're taking LOs and, you know, in some ways they're having to be more involved in social media. So the opposite way, taking a social media strong person and turning them into an LO. What do you think about that?
I mean, I tend to think that we understate how much you really need to know about mortgage to be an effective mortgage loan originator. You know, I've been in situations where we've put up, you know, quote, marketing person out there, say, well, just bring them in and then we'll take care of them, you know, with the mortgage, you know, all the detail stuff. And that's never been something that I've seen and is working. You know, I'd rather, you know, have somebody run social media, you know, kind of from a CRM standpoint, that it just kind of happens and the LO doesn't really even have to touch it other than, you know, chase after the leads it brings in. That might be old school thinking, but sooner or later, you need to know what you're talking about on the mortgage side as far as product features and structuring deals and, helping people, navigate through, which Scott had pointed out earlier is getting to be more and more of a complicated process and more documentation to get the same loan done. So I would not consider that.
I agree with Dave on that. We're trying to basically take our LOs and make them, by hiring the social media expert, make them more social with the different avenues that are out there. Because I'm in complete agreement with what he's saying, that you've got to know the transaction now. The folks, they can go online and find someone else that at least get them where they understand the transaction. If you've got someone stuttering, we get that call all the time. Hey, I've just had a nightmare with an online LO. Yeah, I don't want this and this, and at least give me the answer. So I think it's more important to have the mortgage knowledge than the social media. I think the social media can be learned easier than mortgage knowledge.
Yep.
And whatever they hear on social media, if you beat them by an 1/8%, they're going to come to you anyway. Seems like.
People are still looking too for that advisor. It's a big transaction. It's not, and having someone, I don't know, maybe that's not true with the younger generation, that they're more interested in the people that are out there socially versus the people that actually have the knowledge that maybe aren't as social.
Well, I think your point is well taken, Faith, in that I think we're still focusing on, 40 plus and that being, a good market for loans, and the 25 to 35 aren't ready to buy a house yet, but they're going to be the next phase that comes in, and they don't want to come into the bank, and in a lot of cases, they don't want to talk to anybody. So I don't know what that's going to look like, and maybe that's, shows my naivety about social media and the next generation of home buyers coming in.
Yeah, influencers are such a big part. So I have actually she turns 33 tomorrow, a 33-year-old, and a 27-year-old. But it's like influencers, I think, are so much more ingrained in their lives in multiple different ways, from what am I wearing to what am I doing, and all of those things.
Well, maybe we just have to sponsor influencers. Is that how you do
Yeah,
it?
that would.
No, I think that was kind of the point of that question.
Yeah.
I think if you ever got the LO that was an influencer, in other words, you had a loan officer that was not, and they were the influencer, they would take that 25 to 35 crowd and run with it. It's just,
Yeah.
The mortgage knowledge is so important, and especially, I'd like to say the loans were going to get easier at some point, but this may be what the borrower looks like for the future.
Yeah.
Yeah. I don't know. That's just a very, very, very interesting question. We'll have to wait and see what happens with that one and how things are going. All right. Long question. I'll warn you before we get started here. And this will be our last question. We've seen a trend in MLOs signing non-competes and not being able to originate in their home market if they make a move. State rules are challenging to navigate with these. Are you seeing this in your market? And if so, are there any solutions that you would like to share? Do non-competes still hold up in both of your markets?
Yeah, that's what I was going to say.
World?
We're seeing more the non-solicit than the non-compete. A 6-month or a 12-month no solicit on the sign on, but the non-compete, at least in Louisiana, we've had several take them to court and they've won. They haven't held up. Now they still may get them signed, but I think if you get a decent attorney, they can win in our state at least. So that would be my suggestion: is if you have that, spend a few bucks on an attorney and get their opinion on it, because I think you may win in a state court.
Yeah.
Yeah, I don't deal in that space, so I really can't speak to it.
Yeah. Here in Minnesota, the only place that non-competes, true blue non-competes really hold up is we have a very large medical sales presence here in the Twin Cities. And if it's something that's medical or something that's not known to the public that you're selling, that you have that, those will hold up. But everything else here kind of has gone to the wayside with the right for people to work in their industry. So very interesting. It'll be fun to see if other people have that. And Mark Renault commented too, from what they've been seeing, they don't hold up. They don't hold up very well. I think it really depends on the state. that
Faith,
you're
we're still seeing big sign-on bonuses, which is crazy, but we're still
You
seeing.
are?
Yeah. With, we've got a few banks here that are actually doing it, which is completely odd.
I thought that had kind of gone to the wayside. But now
Well,
people are
we see
expecting
'em.
the market to get better. So are they coming back?
I guess it's one of those you can't, you kind of just scratch your head and it's like, okay. And
Dave,
and,
do
and
you see
Ellis
that too
Ellis
in
have
your
been through so
markets?
much.
Yeah, we see them, sure.
Wow, I'm kind
Yeah.
of surprised by that one, guys. I guess, you know, we're predicting the market to change. We're all hoping that it changes a little bit. Volume goes up, affordability is happening, and there are more homes out there for people to buy. So we're probably in for another new wave here pretty soon.
Yeah, I mean, you'd have to justify the expense, going in, and that has to be on the assumption that you're gonna be able to keep the person, given your, your
Right.
spreads and your commission, and I mean, that's a leap, right? It, because you're not gonna claw anything back, and I don't care what they say, it's gonna be very difficult, and by the time you amortize or however you have to account for that, and in a down market, and then you got to cut your pricing because he's squawking about competition out there. I mean, everything seems to counteract the logic of doing that, in my opinion.
Yeah, it's a head scratcher, Dave. I agree with everything you just said there. And you just kind of like, okay, we're not matching that. If you want to go, go.
Yeah. Yeah. Sometimes the grass isn't always greener, as we all know. I appreciate both of you. It's been so fun being on with you, Dave, and you, Scott, today. Thanks for your feedback. You got great press in the chat that people were loving that you were being so honest about the answers to the questions. So thanks so much for doing that. Come back next Friday and see us on the Fix. It will be Melissa, hopefully back here next Friday. We'd love to have you all join us. And if you have questions that you want answered on the Fix, send them over to one of us. We would love to answer them for you on the show. Appreciate you both. Thanks for doing this
Right.
today.
Thanks, Faith. Appreciate it. Y'all have a good weekend.
Bye, everybody. Have a good weekend.
Bye.